Hello everyone, we talked about recessions in my last video. Today, I'm going to walk you through some recession-proof assets. Regarding recession-proof assets, most people would agree that gold is a good choice. However, the truth is gold is not a perfectly safe asset during recessions. Whether gold is a good investment or not depends on recession specifics and the time window of your investment. Please always keep in mind to do your own research and use critical thinking before making any investment decisions. Now let's take a close look at the performance of gold. The data of gold price is gold fixing price in US dollars at 10:30 a.m. in London bullion market. The data of stock market is adjusted closing price of S&P 500. S&P 500 is considered as a good index to track US stock market movement by both professionals and academics. Monthly returns are equal to prices on the last day of each month divided by prices on the last day of the previous month minus 1. If you bought an asset at the end of last month and prepare to sell it at the end of this month, you will earn its monthly return. Cumulative returns are calculated as the prices at the end of each month divided by the initial price minus 1. This cumulative return measures your return by holding an asset from the starting month to the future. This figure compares cumulative returns of gold and S&P 500. The shaded areas are recessions. We can see that in the most recent two recessions, S&P 500 dropped a lot, but gold was stable. Therefore, gold works as a safe asset in the most recent two recessions. From the beginning of 1970, the average monthly return of gold is 1.55% during recessions, but the average monthly return of stocks is only minus 0.54%. These numbers are consistent with our impression that the stock market suffers, but gold stays strong during recessions. If we compare volatilities of gold and stocks, we can see that from the beginning of 1970, gold has higher standard deviation than stocks, which means gold is more volatile. Let's review some statistic basics in case you already forgot what these terms are. Standard deviation can be used to measure volatility. It is equal to the square root of variance. Variance is equal to the average of the squared deviation of a variable from its mean value. Both variance and standard deviation are measures of dispersion. Higher standard deviation of monthly returns means higher volatility. The last column in this table is a correlation coefficient of gold and stocks. A correlation coefficient is equal to covariance divided by the product of two variables' standard deviations. Covariance between two variables is equal to the average of the product of each variable's deviation from its mean value. A correlation coefficient takes values between minus 1 to 1. A correlation coefficient of 0 means two variables are not correlated at all. 1 means they are perfectly and positively correlated. Minus 1 means they are perfectly and negatively correlated. This table shows that gold and stocks have very low correlation. There are 7 recessions from the beginning of 1970. This table shows that there were 2 recessions when gold failed to resist market downturns. In both recessions starting in July 1981 and July 1990, gold was even worse than stocks. In the recession starting in July 1981, gold dropped quite a lot, but the stock market performed well. Why gold failed in these 2 recessions? My conjecture is that because the performance of gold was much better than the performance of stocks before these 2 recessions. Due to mean reversion, gold was hit more than stocks when these 2 recessions arrived. However, I personally don't think the next recession will be similar to these 2 recessions, since stocks have performed much better than gold after the 2008 recession. Anyways, whether gold is safe during a recession depends on specific situations before and during a recession. Another important factor is investment horizon. This table shows us different investment results when we start at different times. From the beginning of 1970 or 2000, gold is better than stocks in terms of cumulative returns, especially from the beginning of 2000. However, the result is reversed if we start from the beginning of other decades. Therefore, it is hard to tell whether gold or stocks is a better choice for investors. The fact that gold is as volatile as stocks is worth attention. Another commonly recognized benefit of gold is that it is a good hedge against inflation. However, this claim is not very accurate. Let's take a look at this figure. The x-axis of each point represents Consumer Price Index, or CPI change in percentage from a year ago. The y-axis of each point is gold price percentage change. If gold price change and the CPI change have perfectly positive correlation, we should expect a straight line with a positive slope. If the correlation between gold and CPI is high, these points should be close to a straight line. Unfortunately, we can tell that there is no significant positive correlation between them. Gold is useful to protect us against inflation only when inflation is extremely high. Another recession-proof asset besides gold is treasury bonds. To study performance of treasury bonds during recessions, I use the data of TLT. TLT is an ETF to track investment results of treasury bonds with remaining maturities greater than 20 years. The data starts from July 2002. I only found a longer time series of yield data for long-term treasury bonds, but not price data. If anyone knows where to find more historical price data of treasury bonds, please let me know. From August 2002, TLT has lower average value and a standard deviation of monthly returns than both gold and stocks. Surprisingly, the standard deviation of TLT is not as low as I thought. The correlation coefficient between TLT and the S&P 500 is minus 0.31. Which means the negative correlation between treasury bonds and stocks is more significant than the correlation between gold and stocks. Given that our data is only available from the year of 2002, we need to check whether this observation still holds before 2002 once we get more data. The yellow line in this figure is cumulative returns of TLT from August 2002. The green line is cumulative returns of S&P 500. We can tell from the figure that in the most recent recession, S&P slumped but TLT went up. Lastly, let's talk about utility stocks. A lot of people think utility stocks are more resistant to recessions than other stocks because people need to use utilities no matter what. To check performance of utility stocks, I use the data of DJU, or Dow Jones Utility Average. It is a stock index based on stock prices of 15 utility companies. This table shows that from April 1957, utility stocks have lower average monthly returns than S&P 500. They also have lower volatility than other stocks. However, utility stocks are not as recession-proof as what we expected. The correlation coefficient between utility stocks and S&P 500 is as high as 0.71, which means utility stocks generally fluctuate along with market trends. Now let's take a look at the cumulative returns of utility stocks and S&P 500 from April 1957. The red line is S&P 500, the blue line is DJU, the index of utility stocks. We can see that in the most recent two recessions, utility stocks declined with S&P 500. There were some cases when utility stocks performed well during recessions. In the recession beginning in the year of 1981, the stock market first crashed, then recovered. On the other hand, utility stocks were stable with minor increase. In the recession from early 1990, utility stocks also showed much smaller volatility than S&P 500. Now let's summarize what we discussed about the three recession-proof assets. Gold is a good recession-proof asset in general, although there were two recessions in history when gold did not work well. Gold is not effective in hedging against inflation unless inflation is super high. Moreover, gold is as volatile as stocks. The performance of long-term treasury bonds during recessions is also remarkable. It is hard to compare treasury bonds and gold given the very short time series of bond price data I have. Comparing with treasury bonds and gold, utility stocks are not safe during recessions. Alright, this is the end of today's discussion. I hope you find it useful. Thank you for watching. See you next time.